in terms of inflation, you could say that the US is taking the brunt of it, then a bit Europe, and certainly the emerging markets ex-Asia. That's LATAM, Turkey, Africa. Asia is lagging behind. That said, what will happen with generally inflation globally is that central banks will start to tighten and raise rates. And because obviously people are looking for yield, that forces central banks, even in Asia, to consider how they could tighten things to defend their currencies, for example. So yes, at the moment, inflation has not a direct effect on Asia. It's pretty mild, in fact, but it will come. So we are a bit lagging behind, which is a good thing, but is inevitable. Sri?
But what you're saying then, Terry, is that there are very material credit risks for borrowers that are particularly exposed to rising cost base, given the supply chain bottlenecks, given how inflation is quite deeply embedded at the moment. Just how pronounced are those credit risks, Terry, and in what sectors do they lie?
Right. But by way of background, when we computed from the sample, the loss-making entities was for the decade prior to COVID was around 3% plus. We are ending this year, 2021, about 7%. So that's double. This is sustainable provided rates are kept lower and investors and lenders are prepared to say, okay, your earnings and revenue will probably go up in the next few years. I'll hold on. But if rates come pretty fast at 300 basis up, then there's a shock and then it goes up to 12. Then it comes back to lenders and investors ready to roll it over. And the sectors, obviously, you guys will know the usual sectors, transportation cyclical, which is not still fully recovered, leisure and sports, because obviously people are reluctant to travel and spend. So those two sectors are the ones we identify. Sri?
Yes, Terry, but we all know it. It's been very clearly telegraphed by the Fed that normalization, the taper and then tightening, is going to be a well-communicated, gradual process. The last thing that the Fed wants to do is to upset the markets, is to rankle the markets. So with that in mind, isn't this going to be a manageable situation?
Right. In that respect, interest rates, well, obviously there are two parts, the policy rates and the spreads. So the policy rates, you're right, the central banks will try and maintain a degree of stability. The question is the spreads, and we've seen it, I think, from time to time, right, this year, where investors get skittish. They say, I'm going to hedge my bets, I need more spreads. In Asia, for example, because of the Chinese property development situation, we've seen the spreads on an option-adjusted basis go up for the speculative grade. So that can happen. So it takes, I guess, cooperation between both the central banks and the market participants if you want to keep interest rates low. So this particular stress test is more on the spreads because, like we do see central banks trying to do it gradually rather than dramatically.